Good morning, everyone. Welcome to another week and to the trading session. As you know, trading futures does involve risk. It's not suitable for all investors. The information in the presentation is for educational purposes. It's not a trade signal service, not intended to be financial advice. Morning, David. Morning, John. Eben, thanks everyone for tuning in today. Coming off the technically not a market holiday, or at least a full market holiday, but the 3-day weekend, and a couple things we can talk about there with how I play holiday weekends, or especially as we're going into the holiday season. Things like Thanksgiving, Christmas, New Year's. There's definitely some things that you can kind of expect every single year. So we can talk about that. In the overnight, we have this big triangle here on the ES and kind of converging around this 3089. We are gapping up here. Wasn't sure if we were going to make it or not. And the close was an 87.75, so we'll likely be able to hit that here in the next couple of seconds. But technically, we are gapping above yesterday's range. So the one thing to consider here before we kind of get away from the daily chart is, yes, we're outside of yesterday's range, but it was a bank holiday, and regardless, yesterday's high and low sits inside of Friday's high and low. And so we are inside of a larger candle. And anytime we have that situation, we can see it as a consolidation until we break out above or below the larger range. So in this case, Friday's range encompasses everything that we have after it, both Monday and so far today. On the flip side, if we look back here to the end of October, we have a widening range where we start tighter and then we get higher high, lower low, higher high, lower low. So a widening formation. Also a variation of consolidation, if you will, but those tend to be a little bit harder to trade in the moment, to day trade, because you have bigger swings. You're breaking highs and then you're failing a breakout, and you're coming down, you're breaking lows, and then you're reversing, you're failing that breakdown. So gap fill already hit here. The gap was small. If we look at Friday's close, that's a 90.25, and that is just basically where we opened today. At 90.25, then today's open is at 90. So given the overnight, this big triangle, its high is about a 94. So that puts us over Friday's high, but not quite all-time high. And then the low from the overnight is an 82, and that puts us not quite below yesterday's range either. So nice shaped triangle, pretty symmetrical, and converging right around the close from yesterday here in 88. And typically a triangle like this leads to a continuation, and the pattern last couple of weeks here has been to pull back slightly or move sideways or drift for a couple days, not really long enough until this is the first point where we have like a full week of trading where I could kind of put my cursor through the middle of it, and we can see, touching the line a couple times, a little bit below, a little bit below, above, and then touching it again around this 3080. So that's about the most consolidation we've had on this entire run up since the Fed meeting a couple weeks back. Let's go to the 5-minute. Technically, let's see, now our range is 3 points. Technically, the first 5-minute bar is in play. You can bracket it here. So as long as we stay within 4 points, as long as this first candle is smaller, 4 points or smaller, I'm good with taking a buy stop above or a sell stop below this first 5-minute bar, because we opened outside of yesterday's range. Now that kind of cautionary, just because we're still within Friday's range, but there's nothing wrong with it. Would be a 90.75 long or an 87 short. So we'll see which one gets triggered, and if it does, see if we can get if that can coincide with some follow through here as well. So there's the 75. And a little bit of a swing high break here, but a lot of times you'll get a pullback now to be about an 80, about an 89. So we broke out by a tick, didn't get an immediate pop. Kind of sitting on it versus breaking out and then an immediate drop. Breadth and advanced decline, nothing special, which makes sense that we're at yesterday's close area, not far. So the breadth and advanced decline line mimicking a pretty even balance. Another tick up. Breaking these little bit of a swing high, so that's good. The start of this, now we can definitely say we're starting to break the triangle here. Breaking, see these this downtrend line or these swing highs, however you want to draw it. But I'll keep this retracement going here, because at some point we're going to pull back, and it's usually used when you're in a triangle. It's the swing low before the breakout in this case, and then notice how the 50%, at least right now, kind of lines up with the apex. It might end up lining up, something like here where it's up at these swing highs, but that's why you just bracket and go with whichever direction it goes, because if we rally and don't get a full pullback to a 50%, then you're already in the trade. 92.25 is the first target. So see if we can make it there. That's just 1.5 from entry. You could use 2 points. I've always used a 1.5 on the 5-minute. I've just found that gets hit a little bit more, whereas with the retracement, your entry tends to be maybe slightly better, if you want to use that phrase, versus buying it on the breakout with the momentum. Like, let's say, buying it here on the breakout versus buying it on on a little bit of a dip, you might get an extra few ticks out of it, so then you can get an extra few ticks on that first target. And it traded 92.25, but I did not get a fill yet. And that's an important distinction that I did a little little blog post on sim trading versus real trading, at least from my experience back way back when, and I did a little playing around with some of the toss stuff to put that post together. And on a sim account, you can get a little bit tricked into some better fills than you'll get in a live environment. So just be aware of that. So now 90.75 is the entry, and so 89.75 is still the stop. There's no real adjustment to make. That does put the stop underneath. Well, not quite. What did I say? 89.75. It's kind of right at the 50. Not ideal, but I'm not going to widen it. I'm just going to leave it. The idea here is that if the market starts trending right off the open and it doesn't make any serious pullbacks, or it doesn't retrace enough to give us a quality entry, or at least something with decent reward to risk, that you can take a little bit of risk early and have the potential for a pretty sizable gain. So I'm okay with taking a trade in that situation that's more like with the momentum right away, and then having a tighter. So on these, I used to use a 1.5 stand on the 5-minute, and I went back through hundreds and hundreds of trades, and I looked at all of my winning trades and all of my losing trades, and I determined that the winning trades, they're taking little to no heat, and so whereas the losing trades, there it goes, our first target, our losing trades, they're going past a point, and most of them aren't turning around at one tick away from my stop. So I decided to tighten a little bit. So 1 point stop is what I've been using for quite a while on the 5-minute. And with the other thing is, like with the retracements, you'll see me do multiples of 3. So like if I'm trading 6 contracts, I'll do 2 off at the first target, 2 trail, and then I'll have 4 to trail, but usually I'll either trail them in groups of 2, or maybe I'll take 2 off at the first target. Again, this is for retracements on the 512. 2 off at the first target, 2 off at some kind of larger. Let's say we have a spike down and I start trailing each candle, and then I'll keep the last 2 to be a little more conservative if I can with my trail stop and hang on a little longer. Whereas when I trade on the 5-minute chart, I just keep them even numbers. So if you're trading 6, I would do 3 off at the first target and then hang on to 3. The very first 5-minute bar tends to have bigger runners, just because if you do get in a running day right off the open, you're kind of in the early move. But if you're trading, like if we go back to yesterday, and let's say it wasn't a gap yesterday, but we pull back, and then you take this 740 bar and you do the same thing, put a buy stop above highs there. Or you come up here and you take a short on the 825 bar. Some of these other trades can get, a 2-point move pretty easy, but they're not always going to see a, 10-point runaway screaming winner. So to try and equalize everything and not have as very many variables, try to keep things as even across the board as I can. Yeah, Trump is speaking at the top of the hour. I don't. If something pops up, great, but I wouldn't necessarily say we're range bound at the moment. We could stall a little bit, but I wouldn't be surprised if we spike or drop versus just go range bound. The thing is, with a first target hit already, and then now this next candle forming, we can move up to a 90.75 stop, one tick below this 740 candle here. When you already have a first target hit, your risk is reduced on the trade. So then I'm okay holding through most news announcements. I don't trade on the FOMC days, so that's not an issue. But for the most part, if I have a first target hit, or if I'm in the black on a trade and we're coming into the top of the hour where you typically have some news after the first 30 minutes, then I will just hang on to it. So I'll leave my stop here at 90.75, and then if this bar closes and we're still above that, then I'll just keep bringing it up. So the same method of trailing when the 512 is moving aggressively, only on the 5-minute. So, and you can see how every candle has made a higher low and a higher high. So we're there's no need to have a super wide stop or excessive risk, because I want to either be in and on it and it going basically immediately. I mean, it was within a minute or less, or it to kind of peter out and change trend, and then we can look at a trade in the other direction. So the criteria for when do you take the first 5-minute bar, when would you bracket the first 5-minute, basically just putting a buy stop above and a sell stop below. I do it when we open up, when the opening price is above or below the prior day's range. So yesterday's high was here, and we opened up here. So we were gapping up. Yesterday, technically, we opened up within Friday's range. So the low of Friday was here, and then the open was within that range. And then look what happened. We broke above its high by maybe only one tick, and then we got some selling right away. And I've found that the days that either run really fast, or the days that, let's say we gapped up pretty big, but then we sold off to the gap fill and closed, we moved from the open to yesterday's close. And if it was a gap up, let's say we moved down to the prior day's close. If that range is big, then that's also a good trend. Like yesterday, let's pretend that this was the low on Friday up here, and we had gapped down and we were outside the prior day's close. Well, if we gap and go, okay, we can get in that trend off the first 5-minute bar. If we gap down and rally and fill the gap, that's also a good distance to capitalize and have a decent trade that may not get a pullback to the 50% before it makes that move. So that's kind of the reasoning behind the first 5-minute bar and why it's more valuable or significant than any other 5-minute bar in terms of getting in an early trend. Now, if we come up here, we put in an inverted hammer and then roll over, then you can short below the high bar and ride it down as long as it trends, if the trend changes. So a range bound day can be just fine for trading 5-minute bars. So now that the candle closed, same thing as I would on the swing trade or any other trade moving underneath. It's a 91.75. So all of my strategies, I guess you could say, it's really just one or two strategies that are transposed to all of these different markets. So, day trading, if this was a daily bar and I bought on a pullback, let's say down here, and then I started trailing each candle's low like I'm doing here, it's the same trail stop. Let's say bought a retracement back here on the ES and the 512, then trailing either swing lows on the way up or each candle's bar. So there's really just a couple of approaches that I take for entering and for trailing my stop, which again, simplicity, you don't have a lot of moving parts. It's for me that, clear desk, clear mind kind of an approach, or organized desk, organized mind. So if I don't have to think a lot about, okay, what am I going to do to manage the trade if it goes against me right away? I got my stop in place. Okay, what am I going to do if the trade goes in my favor right away? And I believe we are making a new high close to it. Oh, very close. 96.75 is the all-time trading hours only high, and we made it to a 96. So you can see, look at the move off of here's our triangle. This is the overnight session, and we really have not had a pullback. If you use the swing low, like the more major swing low, we have not had a major pullback. You could kind of come in here and say, well, I'm going to use this one candle and draw it up here like this. And you could grab an entry there, but then the next one really didn't pull back. And then when you get up into here, saying, okay, well, here's a swing low to high, 94, that's already 4 points off of the apex or the breakout. So not that the market can't keep going higher, but when you're looking at reward to risk, that definitely comes into play. So Stan asks, well, what about this Friday's bar? Whereas, yesterday's, so today we gapped above yesterday's high ever so slightly, but we were still within Friday's range. The significant part to me is gapping above the prior day's range. And then in the back of my mind, I consider, okay, we're still within Friday's range. So if I see like if Friday's high was a 92.50, and so if we came up to 92.50 and rolled over, then I would see that as kind of a double top. But since the pattern basically for the last month or so has been to kind of make a new high and then just get a couple days of pullback, if that. I mean, we're only pulling back to fill a gap here. So we gap up, we pull back slightly, fill this gap, and then bounce. This one is still unfilled between the first of the month, but then we gap up, we pull back 2, maybe 3 days, fill that gap, and then bounce. And so we gapped up again last Thursday, and then Friday filled that gap. Yesterday, kind of a semi-trading day, just because it's you have some markets closed and bank holiday. But we're sort of continuing the trend. Okay, it's been our a couple of days. Now we should be returning to new highs. So that's been the pattern. So jumping on, weighing that risk of, okay, well, we're still within Friday's range, but we're right at the top of it, and we're ever so close to making a new high. I weigh that more valuable and worth taking the trade off the first 5-minute bar in today's situation versus saying, no, that's too much risk, that's too much resistance, I don't think we can break through it. I'm saying, I think we could easily break through it because, well, what's the pattern been for the last 2-3 weeks? It's been to make new highs pretty easily, especially when we gap. We've been gapping up and really not falling at all. We're in this very tight channel, and that can be a little bit difficult to trade when you keep gapping up and it seems like, wow, we're so high, how are we going to surpass that? So a 92.50 is now the remaining stop. If we have a couple of inside bars here, then I'll leave my stop at 92.50. When you get into, so one strategy that a few of my traders use is they'll do, so like in this case, 1.5 for the first target, and then have like an arbitrary second target and then trail the third and maybe the fourth contract if they have one. So if you're using, say, 2 points as your first target, let's say you have 3 contracts, you can do an arbitrary second target of like 4 points. You want to look at the reward to risk on each contract. So that's where the value of assessing your exit points comes into play. It's not so much about, well, let me look at the total P&L from the trade. Let's break down each contract into what was its R multiple. Just like you get all these car companies who want to get you into a low monthly payment, but we need to look at the total cost of the vehicle, not just the payment. And this is kind of the reverse. If we look at the total, we say, oh, I made $1,000 on that trade. Okay, great, but did you trade 2 contracts with a big R multiple, or were you trading 10 contracts with a much smaller R multiple? Did you take 8 off at a point and then you just hung on to the rest, or did you have more of an even spread? So the reason I bring that up is because like this candle is about 3 points, and it can be hard for some folks to stomach a 3-point drop or just a pullback of P&L. And so mathematically, if you wanted to use a couple of arbitrary targets if you have enough contracts. The smaller number of contracts you have, you're really confined to trailing because you want to be there for the runner and you don't want to have to pick and choose. Okay, this trade I'm going to trail my stop. This trade I'm going to use an arbitrary target. So if you can have the patience and a little bit of, I don't like the phrase not caring, but you got to give it some wiggle room if you want to get to that big winner. So now that we've broken highs from, like this candle has broken the prior candle's high, once we're only 20 seconds away from the candle closing, so then we can bring our stop up, and as of now it'll end up being a 94. So you look back and you say, oh well, that first target was pretty small, and it was down here, but you have to remember that that first target helps to smooth out all the trades that don't end up like this, where you get higher low, higher low, higher low on every single candle. Not every trade's going to do that. And if we come back over to the 512, we do have a pullback here, but remember I was saying, the reward to risk is a lot less up here than it is right off the open. So I'm okay taking, some risk on the open before the trend has even developed, before it's visible, versus waiting, getting in, 4 or 5 points into the trend, and then trying not just to get in there, but then stay in and not get, run out by a bigger pullback or something like that. We are at the top of the hour, so things could get a little spiky if Trump does have some remarks, but even with a big spike, I mean, that's one of the benefits of trading the E-mini S&P. There's enough trading volume that, I mean, a 2 ticks of slippage would be monstrous. I can't remember a time where I've ever had more than that, and that was trailing my stop when the market was in a free fall, and we got, like, it was going down, I was trailing my stop, and then it got a little bit of a snap and traded through. But that was quite a while ago. Oh, not till later maybe. Yeah, I don't follow all the speaking engagements. I use the Econo Day calendar. You can use any basic calendar. I like the Econo Day one. It gives you the important things. Puts like Jerome Powell speaking engagements on there, and then the main news announcements. There really wasn't anything today. Redbook before the bell, but nothing else news-wise. And then, I just kind of keep an eye on some of the bigger earnings names just to get an idea when, Apple and Microsoft and Google and Amazon are coming out. But otherwise, I don't dive too much into the media stuff. I don't watch CNBC or any of that garbage while I'm trading. Just kind of keep it simple. And I know there's a lot of there's a lot of little nuances, especially as I try to narrate some of the things that I'm thinking. It almost becomes a little too much at times where, you're if you were just sitting there in silence or with some music on, chances are you'd have a lot of the same thoughts or a lot of thoughts, but you're able to process them and say, okay, no, I'm not gonna uh, act on that thought. I'm going to kind of table that thought. Okay, here's an observation. Here's an observation over here. So you're processing a lot of the same stuff. It's just when it's verbalized, it can sometimes seem a little bit like, wow, how am I ever going to be able to take all that information and assess it? Well, you do. Your brain can process it. So it can be helpful to go back and like watch the recordings, or just once your trading session is done, like once you say, okay, I'm going to trade for the first 2 hours of the day, get up, leave for a half hour, or scribble some notes for 5 minutes, and then get up, go for a walk, kind of let your brain process. Okay, so here we want to go down to a 94.50, and that may kick us out right here if price drops. So this candle made a new high, and so and it's closed. So we want to tighten the stop, 94.50. You can reverse, meaning you could, if you had one contract, you could do a 2 contract stop, which would get you out of the long and put you in a short. Just because now this is the highest bar in the bounce. Just like when I talk about swing trading, I'm looking for the lowest bar in the pullback or the highest bar in the rally. That's this right here. You have higher low, higher low, higher low, all the way up. We have a higher low. We also have a higher high. And so if we break this candle's low, that means that our short-term momentum has changed, and then now I'd be game for a short. We may just get a couple candles sideways and then continue up. We may break this red candle's low by a tick or two and then continue up, in which case, I get kicked out of the long. But the thing is, you never know, and so you have to play the odds versus playing what you think should happen or what you want to happen. Like, sure, it'd be great to get out of this long and then have it drop 10 points and reverse at the same time that they get out of the long and then ride it down. Or it'd be great if this just went up 10 points from here and continued making higher lows. But there's no way to know that definitively, no matter what indicators or things you look at. So you have to just play the statistics by looking at a lot of your own trades, by looking at the candle patterns in the chart, so that you can say, okay, yeah, most of the time my trades go at least 2 points. So if I put a 1.5 target for my first target, I can get that hit. I can be in a free trade, and if it does reverse on me there, okay, it's a small gain or a scratch trade, and I can move on to the next one, and I can trail my stop. And this is where these trending days, or trending environment, what are the characteristics? Well, it's higher highs and higher lows. Every single candle is making a higher low. Like, you don't have to overcomplicate it. And so you say, okay, well, if every candle is making a higher low, where would I be wrong? Or said another way, where would I want to place my stop because the trend would be over or at least changing? Well, it's probably below that candle's low. And so now when we got another minute and a half, if this candle closes without breaking the current low, there's not really anything to do with the stop to tighten it because it's the exact same. but you're still in the trade. So a couple seconds, this candle will close. Again, nothing to do with stop movement because it's already one tick below this candle. And you just keep on keeping on. 90.75. Stop is at 94.50. Plus you've got the first target locked in. So if you look at it as like you don't want to get in the habit of saying, well, my max profit on the trade. I guess let me rephrase that. I like to look at what the max profit was on the trade just for recording purposes, but I don't get hung up on, oh, I did have 10 points and then I finished with 8, or I had 10 points and I finished with something like 3 or 4. You know, I've looked at enough trades, like I've gone through enough of my trades to where, yeah, occasionally you'll get like a candle that rips, or you'll get it's a little bit easier on the 512 to tighten your stop because the candles are obviously forming quicker. So like if you were coming in here trailing each candle, you're gonna have your stop be higher. Whereas in the 5 minute, you know, the candle takes longer to form. But there's only a handful of trades that I've had, and we're talking like over hundreds of trades, not just 10, that have a major spike and then come all the way back, and I give up like 6 points. But there are a lot of trades that get that big spike and form that bull flag. So you have a big spike, the pole, and then 2 or 3 candles where they move sideways. And then we continue up, and you get to tighten your stop 4 points in one go, or 2 points in one go, and then it keeps going, even if you're not necessarily making a big leap in your stop. Just like here today, it's, you know, half a point, a tick here, a point here, little increments, but over, what has it been, half hour? You know, all of a sudden, wow, you're locking in those gains. And so I have seen more trades do that where they end up with a bull flag within the trend, and you can just be a little bit of patience on the pole, like right here, let's say, if we go into a couple candles where we don't make a new high, then I'm okay with just leaving my stop down here to see if the trend continues. But yeah, it is a little bit easier to trail or to tighten on the 512. You'll get taken out a little quicker, but you'll lock in gains quicker because the candles are smaller. But again, I like the 5 minute chart across most markets, but I don't trade that many markets. I like the ES, I like the NQ, 6E in spurts. We haven't talked about that in quite a while, at least in the room here, just because there's enough going on with the ES. But if you've got, something like the ES and the NQ or the YM plus, a half dozen day trades, you can really um, do a lot. Yeah, even the NYSE tick, watching for high ticks at highs and low ticks at lows in a trending day, you want to be a little bit careful. It's more beneficial in a range-bound day where you're fading highs and buying lows, because what will happen in a trend day is you get a high tick, and then 20 seconds later, or even a few seconds later, you get a new high price. So if you're in a trend, I don't like to close out based on the NYSE tick. Like if it's a larger trend, if it's just we've opened up and we haven't been making consistent higher lows all morning, then the NYSE tick can be really helpful. All right, so still the same price of highs, 98 and a quarter. So just going to leave her at 94.50. See if we can't break this high and then be able to bring the stop up once again. So coincidentally, we've been talking a little bit more about the 5-minute stuff lately, and I'm going to be doing I've been talking a couple of the trading sessions. I've mentioned the master class that I'm putting together. The idea came from the Traders Expo. I wasn't able to make it to Vegas this year, but they always ask if I want to do like a 4-hour, a couple hour in-person master class at the expo. And so since I couldn't be there this year, I thought, oh, maybe I'll try it via this environment where we do it over GoToMeeting. I run through a couple hours of, we'll go through the process, basically everything encompassing this 5-minute strategy, and then we'll have some dialogue, answer questions, go through some examples, record the whole thing so then you can review it. So I'll be doing that in December, and I think I've settled on the Monday, pull up my calendar here, Monday the 9th is I think the date that I'm going to go with, just at the closing bell, and do like a 3-hour masterclass where we can go through in depth, specifically the 5-minute strategy. And again, we'll record it and be able to answer questions. So I think next week I'll send some more info out on that. And if people like that format, because I know the trading sessions are super helpful because you can have that dialogue and answer questions and look at charts versus looking through, watching a video by yourself and then asking a question and maybe having to wait a few hours or a day to get a response. Seems like that might be a good fit, and obviously it works for the Traders Expo as well, so thought I'd give it a shot. So here's kind of that bull flag, the pole at the 805 bar, and then a couple small candles. It's okay if we come down a little bit here and break this candle's low, because this candle did not make a new high. So you're kind of inside bars for a couple candles, and a lot of times you'll see that. You get one candle, maybe the next candle forms a little bit of a tail, and then the third candle makes that resumption to the new high, and you can kind of see it over here on the 512 as well. The bull, the pole here, and then the consolidation with these little dips. The thing I like about the 5-minute is that it's a bit easier to systematize, if you will. Like, yes, you can, anyone can identify a swing high and a swing low and draw a retracement between the 2 points, but there's a few more subjective nuances with retracement trading that certainly took me longer to pick up and kind of get the hang of, if you will. So while I have a lot of folks who do very well with retracements, it can be a little bit daunting or frustrating at times because it takes time to really get a strong feel for, okay, here's 5 retracement setups. Well, I'm going to take these 3 and pass on these 2, and developing that that toolbox of how you're going to discern which ones you're taking and which ones you're not can take a little bit of time. Yeah, that's the other good thing. So Stan asks, well, what if you don't get in a trade right at the open? I'll come back to that in 1 second. So we're now making that new high, and the 97 would be the new stop placement below the low. We're getting a little tight up here, so I wouldn't be surprised if we maybe, and it's been 45 minutes or so, 50 minutes of this trend. So it wouldn't surprise me if we roll over here maybe at the hour mark, but 97 is now the stop. So yeah, if you don't get into a trade right off the open, off that first 5-minute bar, and it does something like this, where every single low is a higher low, and how high are we into new highs? 99, we're 2 points, almost 3 points into new highs. Sometimes there's nothing to do. There's no entry or there's no opportunity. I mean, you can take a risk in, taking a long up at highs and just saying, well, the trend's strong and let's see if we can get in and stay in. But that's the key, staying in. Because if you were to trail, let's say you drew up this retracement that I had here, the 94.50, actually it'd be a 94.75 when you round up and add a tick. If you trailed the next retracement, see how it kicks you out? It dips below the 61.8 and then continues on. So it's not always a matter of like, yeah, you would have gotten first target hit and been able to come out with the winning trade, but if you trailed the next 61.8 versus waiting for it to pull back and trail the swing low, you could get kicked out and not end up with an opportunity for that runner. The other thing to consider is that when you do, so I call these breakout setups, where you're bracketing a candle or you're putting a order above, let's say, a candle, and the market is punching through your order, versus like on a retracement where it's a limit order, the market pulls back to your order and your order is out there resting, the market comes down and fills you. You've got your line here and the market punches through it and then fills you. So you can end up with a tick of slippage on the punch through, because the way I do it is I set it up as a buy stop, so it becomes a market order. But that's the exact same thing I'm doing with swing trading, putting a buy stop above the candle's high and then letting it punch through. Now, sometimes you could, if you go to your dome and touch, like you've got it set to a market order, and you click on the price that the market is at, sometimes it won't want to put your order on. And I've only seen this a couple of times where if you touch the actual price, it's like it thinks that it's a mistake. But in most cases, like even here, where the next candle forms and then breaks the high pretty quick, like if you're watching your clock and then I just kind of hover my cursor, okay, and 92.50, so it's going to be a 75, and as soon as the clock rolls over, like so right here, I'm saying, okay, it's a 99.75. Now I got my cursor on my dome, but okay, 99.75. And now we're waiting, price hasn't broken. So my order's in. Well, it's not in right now, but it would be in if I wasn't in. And the order's, it's in there, and then it's going. So I never had trouble on Infinity. And I don't recall having an issue on toss. And then it would fill. So 30 seconds after, if the candle closes and it immediately goes into new high, just take the extra tick. You can put your order up an extra tick, or you can put your order on like 10 seconds before the candle closes, but that would be the exception, not the norm, where the new candle is forming and making a new high and doing all that in like the first second. Okay, David, the toss. Yeah, I do like toss. The active trader and all that, everything has gotten a lot better. But I still like Infinity also. So we are at 97.75. And still no pullback, obviously no full halfway back either. And just this pullback here that, like I said, trailing the 61.8 when you got you one leg of gain and then likely stopped out. $3,200 is what I've been targeting on the daily chart, not in one day, but just as the next target point. The last couple of days has been good to see, 6 days of somewhat sideways, just to get a little more basing. We haven't really had that, and even that is a little weak, because if we do sell off here, we could very easily make even like a pullback like this, still be in the context of the uptrend, but you could have some big down days here. And you get your biggest down days in the context of an uptrend, and the biggest up days in the context of a downtrend. So for things like 3-day weekends where you're going to have a Monday holiday, Fridays tend to be a little bit slower. I don't trade the day after Thanksgiving. I don't trade between Christmas and New Year's. Depending on when the Christmas holiday is, it can be a little bit slow. like the week leading up to it. But for the most part, this time of year is a good time to be trading because people are usually in good spirits and you get some strong trends. Swing trading's obviously been pretty good here, although Home Depot has not been following suit, kind of put in a little bit of a double top, so I don't have that one in my swing trading basket anymore. Microsoft was breaking out. Russell still lagging a little bit. And the Dow slightly. Oh, here we go. 97, 99. There it goes. So you see how the stop just stays below each candle's low. This is the very first candle. We're exactly an hour into the morning, and the very first candle that has broken its prior candle's low. Just meaning that the low price for the last candle was 99.25. Now this candle has traded 99. So I am out of the long. It doesn't necessarily mean that the trend is over. It just means that the momentum has shifted, and I'm okay with being out when the momentum shifts because it can, lock in what you have, and at the very least, there's enough more bears participating. And if you look over here on the 512, you've got the break of a swing low, you got a little double top. You don't have a high ticket highs, but you have kind of a shift in the pattern of the whole morning. And with trading with the momentum, when I see that shift in pattern, and when you take 100 of those trades where you're getting out when the momentum shifts, the trades that just break by a couple of ticks and then resume the trend, they end up being the outliers, not the norm. Just like your 15-point winners, yeah, they can happen, but they're the outlier, not the norm. So you don't want to base your trading strategy adjustments or how you're going to manage your trades based on just the 15-point winners. You want to cater to, okay, how can I capitalize a little bit with having that first target, but then still have opportunity for the bigger winner, as opposed to pigeonholing and saying, okay, I'm always going to take everything off at 2 points and be out, or I'm only going to trail and hang on for that big winner, because in reality, if you miss a day and that happens to be a day with a big runner, like let's say this trade doesn't end up in your data set, well, if your expectancy is hinged upon a couple of 10-point winners each month and you take one of those away, now all of a sudden your P&L goes to crap. So to smooth that out, that's why I do a mix of the two. Smaller first target that's still good risk to reward, but then something around 1-to-1 or a little more than that, and then the runner. I'm going to I chose to not take a short here, Stan, because we're in this sort of all-time high territory. Um, yes, we're at the hour mark, and that's typically when you see a reversal. Uh, but given the way the morning's trend has gone, even if we got like a 1.5 or 2 point pullback, I would likely see us just sort of round out and then turn higher again. So I would rather just wait on the pullback and maybe go for a long once we do pull back. But even that, we may end up being past the hour and a half or 2 hour mark, and it may end up with just the one trade for the day. And sometimes, actually, a lot of times on the trend days, that's exactly what happens. If you can get in early, I'll have fewer trades on trend days because you're already in the trend, and then there's nothing to do other than trail. Whereas a range bound day, that's when I'll have my 5 or 6 trades, because I might fade highs, buy lows, fade highs, buy lows. You do that a bunch of times, and you catch 3 points down, 3 points up, and you can kind of accumulate those smaller winners a little bit easier. But if you start getting too loose with your stops, then like sure on this trade, leaving your stop a point, let's say, away from the low. So instead of a 99, you use a 98. Maybe you stay in the little bit of a swing back to the upside. But then when you factor in the other 99 trades, keeping that stop tight, especially on a market like the ES where it's a very technical, very tight market, I've seen that do much better. Because in reality, doing all in, all out with a big trail is going to yield the most profit. But again, you're going to miss some days, you're going to miss some trades. And if that trade ends up being the winner that you need in your data set, then your data gets skewed quite a bit. Very good, Chuck. Yeah, so halfway back on everything from ES, NQ, with stuff like oil. So good, ES, NQ, YM. YM has a little more slippage than other markets, or can. The stuff like oil, you'll tend to see the market go down to the 61/8 a little bit more. So I know a couple traders who place their orders at the 61 instead of the 50. I personally don't trade oil, so I don't have a ton of firsthand experience. Gold, oil, the currencies, yeah, it's all The reason for some of that inconsistency with a few of those markets is you get a little bit more computerized trading in various markets, especially at certain times. So, and there can be a little bit more swings based on some of the most recent news or threats, if you will, with oil. So oil can definitely be a challenging one, and I definitely wouldn't recommend folks trade it unless they have some experience in that market or can find some sort of reliable patterns. And that obviously that goes for any market. But something like the ES, the NQ is nice because it's got the smaller tick increments. A lot of times the NQ does look pretty similar to the ES in terms of its trend, and that's okay. I like the NQ over the YM. When you go to the YM on the 512, a lot less trade data. This is this morning. So sometimes I go to a 233, but for the most part, I like to stick with the 512 because if I have to go down to a 233 or a 144 tick chart, then that means there's not as much volume occurring as it is. So I'd rather not compensate for low volume by fitting a smaller time frame. Here we go again, back into highs. And again, you can't worry about not getting out of the absolute high or low. You're trying to catch the meat of the move or a good chunk of the move. And to me, more importantly, in a repeatable manner. I'd be much happier taking 2 points on a consistent basis than a 10-pointer and then nothing. And again, that's where the first target comes into play to help smooth out the week to week and the kind of the day-to-day ups and downs. Now, one thing that I will do is, like, if you're going through every single candle in a time window, like let's say the first hour and a half of the day, if you are long, then you flip here, let's say, and you go short, and this candle closes, so you put your stop above that candle's high, and you get stopped out of the short, so you go short below the inverted hammer here, then you put on a reverse on the next candle, so you're short for one candle, you get stopped out, you go back long, now you're in the trend. I will typically say, well, I'm gonna pass on a short if trend is this strong, but I am okay with kind of flipping direction, reversing, and then reversing again as long as I adhere to the 2 stop out for the same reason, just like if I have back-to-back stops on the 512. So as far as the Top Step Trader, so if you're going through their combine, the 50,000 combine is very similar to like the parameters that they have, really with all their combines, because they kind of graduate with the account size, whether it's 30, 50, or I think 150. But yeah, the parameters that they have are pretty much in line with the way I trade, which is why I do find it very valuable, because you can use it to kind of validate your trading, or like as your test, if you will, or your board exam. And it's a little bit more, well, it's a lot more pressure system, or let's see, how would I phrase this? It's a lot better than sim trading, because you got a little bit of skin in the game. So you're not just going to take any old trade. And then, I've got a couple traders who are funded by Top Step and love it. They don't have to put their own capital at risk. They take a 90-10 profit split, and life's good. Then I have another fella who went through the combine and kind of used that as his validation, but then said, okay, this is good. I validated it. I've got plenty of money, so it's not so much the capital that's limiting me. It was just, let me make sure I get things, let me prove to myself that I can do this. And then so he went through the combine, and then upon completing it, just went back to trading his own account, but this time with more confidence and validation. Interesting low tick down here up at highs. Low tick for the day. So yeah, there's a couple different ways you can go about it, but I'm a fan. And I think that their basic Top Step Trader order execution platform is just fine. But again, I like things simple, so I don't need all the bells and whistles. I see too many people kind of get into trading for the wrong reasons, or with very, very limited funds, and it pains me at times to, I have told many a people, you should not be trading. This is not going to meet your goals, and you're not in a healthy position to be trading. I mean, it can be a very stressful endeavor as it is, and then when you add the financial stress on top of it, like, get your finances in order, clean up any stuff that you have outside of trading, get a bigger plan put together, pay down some debts, or get rid of your debt if you can, and that will make your trading much easier. I mean, you don't have to be 100% debt free, but you don't want to be drowning in silly credit card debts and payments and student loans and all that garbage, and then trying to, okay, I got $2,000 on the side. I can't lose it, because if I do, I won't be able to make my mortgage payment. That is not a good headspace to be in if you're going to be trading. It's a good headspace to be in if you're going to be hustling and doing a bunch of side gigs, and you're 25 years old, and you're, making the most of your day to work your butt off. but trading doesn't quite follow that same approach. If you work harder or longer at trading, it doesn't mean that you make more. So for me, Steve, I was, in terms of like the question of going full time, I was swing trading while I was still working. I was working for an electrical engineering firm and kind of doing most of my trading prep in the evening. I'd monitor some positions while I was working, but I wasn't doing any actual trading. And I kind of was able to see a lot of consistency with the swing trading, and then run the numbers and say, okay, well, if I double my risk, what does my expectancy look like? If I double my account size, what does the expectancy look like? And I felt pretty comfortable. That was probably 2 years of swing trading. And at that point, a lot of I started with a $3,500 toss account and grew that to 50, and then grew it from there. But a lot of the initial confidence came from the swing trading side. Then as I was looking at going full time as a trader, to me that was consisting a lot of swing trading, I was starting to day trade. And it took me a good year to get comfortable day trading, even though I was kind of doing the same thing. It was just I didn't have a time window set up, so I was just kind of open to trading all day long. Oh, the markets are open 24 hours, so I might as well be here all the time. And so figuring that out took some time, figuring out how to get a really good feel for the ES took some time. But once I started to limit myself on the day trading side, it was like the more I limited, okay, limit my stop outs, limit the time of trade, limit the markets I trade, then things started to get a lot better. And it was probably 2 years of day trading that I started to see more results consistently. And yeah, it really coincided with limiting things, limiting the time of trade, limiting the number of stop outs, and then I started to see consistencies, because then I wasn't taking those losers in the afternoon or boredom trades and then giving back all the winners, and then it's like you're up and then you're back to where you started. But again, I was really just focusing on trading, and I was working a traditional job, and this was all through, most of it was through college and then building from there. but you've got low expenses, low responsibility. I had a huge advantage by being able to go down to the board of trade, put in touch with, guys who'd been trading the E-minis for a long time on the screen. Wasn't like I had, uh, trust fund baby with millions of dollars, but I had advantages of the knowledge and experience of those guys, so then I could do more with the money I had, and I was still working to make money to build my accounts, or at least have, plenty of savings and whatnot where there wasn't all this pressure and all that kind of stuff. It adds up, and then you end up with what I feel like is a pretty big advantage. So again, that kind of goes back to the whole simplify, simplify, simplify thing. If you can simplify a lot of areas of life, then you can think a little clearer. Even if you got family, kids, responsibilities, hobbies, recreational stuff, you can only do so much. So it's helpful to focus, but it's also helpful to, sometimes you gotta say no to stuff. Or if you're gonna say yes to trading, then what are you saying no to? So at the very least, if you're going to say, okay, I'm going to trade from this time for an hour and a half each day, and then I'm going to completely unplug and get away from the trading screen and not think about it, and I'm not going to have positions on, and I'm going to go do this stuff over here, whether it's my day job or my fun, or, if you're retired, it's a host of anything that will make your trading and, in my opinion, your life a lot more enjoyable. But if you trade in the morning and then stress about it all day long and think about it and pull it up on your phone, and you're not productive doing something else, and you don't give yourself the chance to recharge, then you just drown and you'll hate trading. Yeah, Stan, I didn't mark the first 30-minute range today, mostly because I can tell that we're out of it and we're not coming back to it. But if I had drawn the high, you can see we kind of pulled back ever so slightly, but then immediately took off above it and didn't even retest it. And we haven't even retested or tested for the first time a halfway back of the day, and we're just about at that 90-minute mark. So if you look at a bunch of trend days side by side, you see a lot of the same characteristics. And this kind of a day is only going to be one in, I don't know, 6, maybe 2 a month, 3 a month, where you get every candle that's making a higher low. You'll get some trends that are really good and maybe a little bit bigger pullback, and then the trend resumes. But yeah, maybe 5 or 6 good trend days on an average month. But we're not necessarily playing for the trend days, just for the trend days. You want to be able to capitalize on the range-bound days too, because the swing trading capitalizes on the trend days, the gap days, the low volatility, and all that kind of stuff. Speaking of which, the VIX is still down in the low teens. So I think we'll leave it at there today. Just the one long and a little bit of a shake here and then resumed higher, but you can see it flattening out. And that hour mark is typically when you see a reversal, especially the pit traders use that hour mark for looking to fade. But what do we got here? Do we have 2 weeks till Thanksgiving? We are at, yeah, Thanksgiving's late this year, so we got the rest of this week. We have all of next week, and then Monday, Tuesday, Wednesday. So basically 2 full weeks. And then we've got 1, 2, 3 full weeks in December. And it looks like Christmas is on a Wednesday this year. So the time between Christmas and New Year's, I won't do any trading. And I'll very likely won't trade the whole week of Christmas because it falls right in the middle. So probably end my year on Friday the 20th or even the 19th. So that gives 1, 2.5 weeks plus another 1, 2, so like 4 full weeks of trading this year, and then kind of slow into January, where the first 2 weeks I'm just kind of watching, easing into things. I'm typically flat completely, even on swing trades. It's just a personal thing. I like to kind of start the year completely flat and then build positions back up from there. So I might be a little bit slow to respond later this week. I've got some family coming to town and over the weekend. So if I don't get back to your email right away, give me a little bit of time, but I'll try to keep my eye on those if you have specific questions. And then I would like to get more info out next week about the masterclass. I've kind of been building it and putting it together, and at this point, I just need to open it up and push it out and try to keep it small. Maybe 20 people tops, so we can have a discussion. But we'll see what the interest is, and that will be in kind of the beginning of December. So hope everyone has a great rest of your day, and I will talk to you all soon. Thanks for tuning in.